Hey everyone, welcome to the Elite Real Estate Podcast. I'm your host, Sam Popple, along with my co-host, William McClellan. How you doing today, Will?
All good, all good. Ready to learn some big strategies today.
Yeah, no, this is going to be a great episode, especially any kind of real estate investor, but especially for our commercial real estate investors, because today we have the tax man who will help save you money on taxes. So Rob Schell is a tax and financial advisor and the co-owner of Innovative Real Estate, where he delivers advanced tax strategies and wealth management solutions to growth-focused businesses. His expertise includes cost segregation, 179D energy deductions, tangible property regulations, and method changes to help you save on taxes. He is a 3-time Inc. 500 recipient, and Rob partners with leaders in the industrial, medical, manufacturing, and commercial real estate sectors to reduce tax burdens, increase cash flow, and build long-lasting financial strength. He attended Spring Hill College, where he developed a strategic thinking and value-driven approach that defines his work today. And like I said, after talking with him, I was getting super excited about all the ways to save money, and I know he can help you all. So without further ado, welcome to the show, Rob.
Hey, good evening, everyone. Sam and Will, thank you so much for inviting me to the Elite Real Estate Podcast. I appreciate this. I hope I can provide some education and knowledge and take your questions and kind of just roll. So let's just jump into this. How do you want to get started? Where do you want to jump off?
Yeah, man. So welcome to the show. For listeners meeting you for the first time, what do you do and how do you help?
Well, I typically work with owners of commercial real estate, but I also work in markets with financial advisors and CPAs and individuals that would do tax returns for owners of commercial real estate. So I kind of spread myself to a variety of different professionals and then owners of real estate. If primarily within the commercial arena, and on a federal level, I know there's probably a lot of people listening in that own single family homes, condominiums, and they're doing long-term rentals and short-term rentals. All those property classifications qualify as commercial property within the IRS tax code. So I work with all those kinds of owners. I live in Pensacola. And I also have a home in the Chicago suburbs. And I kind of spend most of my time on the beach in Pensacola, but I do get to Chicago for probably about, I'd say 10 days every 2 months. I'm up there and have a lot of clients, a lot of friends, a lot of family up there too. So I kind of bounce back and forth. I work across the country and help any owner of commercial property. And it kind of buckshots with who I work with and how I get to clients. A lot of times it comes from CPA firms and CPAs that have clients, and it's really random. I work very closely with a CPA in Savannah, Georgia, and right now I'm doing 3 dental offices in California that are his clients. And I'm like, how did you get this client all the way on both coasts? And it's like the internet and what's happened with how professional services can just map to the internet. It really doesn't matter if you're a qualified professional. You can pretty much do services anywhere. And with that said, I do services, and I don't necessarily need to see the properties I'm working. I do a lot of work in Boise, Idaho. I do a lot of work in Los Angeles, a lot of work in Las Vegas, Manhattan, and New York City. I haven't been to New York City in 15 years. I go to Chicago every few weeks, but I haven't been to New York in a long time. And we're doing a couple of really cool adaptive reuse properties, big towers in Manhattan that are being turned from office into multifamily right now. And there's a whole litany of different tax services we're working on through those projects. And both of them are like 2 to 3 year projects.
Wow. So what got you into the space?
Great question.
Yeah.
About 15 years ago, I had a rental house in Gulf Shores, Alabama, slept 18, beautiful place. Would much rather be there than in Chicago. Swimming pool in the backyard, boat dock. It was a beautiful place. And I rented it out. I had a bunch of my buddies down there for a few days on a golf junket. One of my friends from the Mobile area kind of came in, looked at my pretty house, and it was a nice place. And he kind of looked around and said, hey, you rent this place out? I'm like, yeah, I do. I rent it out a lot. He's like, okay. Have you ever done cost segregation? I'm like, what are those two words and what language is that? The next thing I know, a few weeks later, I'm cutting a check for $8,500 for a cost segregation study. And in that calendar year, I was able to build about an $85,000 deferred federal tax deduction. My friend didn't know about it at the time, but when this was all happening, I was divesting of a couple companies. I was going through a divorce. I had some problems with my personal life and my financial stability at that moment in time. I owed the IRS about $50,000. The wolves weren't at my door, but it was about 6 months out, and I probably had like 25 to throw at the $50,000 debt. Kind of scary. So when this thing came out of nowhere, all of a sudden I had $85,000 in a deduction. It offset my $50,000 I owed the IRS, set me up beautifully for the next few years, because it took a few years for me to use up the other $35,000 of deductions. And that just carries forward in our world. So if you don't use all the deductions we create for you in that specific calendar year, and it wipes you out and you're down to a zero amount you owe the IRS, whatever balance is left over carries into the next year, and then the next year, and then the next year. It never goes away until you use it all up. So it kind of really set me up beautifully. And I'm like, what is this thing? I was in the technology arena. That's where I was on the Inc. 500 for 3 times. I ran tech companies in Chicago for many, many years. And I'm like, what? I didn't know what this was all about. I called the CEO of the company that my friend worked for and that I was a client of at that time and said, hey, can I sign an NDA? Can I sit on your Monday morning sales calls? I just want to learn the language. I'm running 3 other companies. I'm not really interested in doing this right now. And I kind of religiously made this part of my schedule for 10 months. And after 10 months, I knew enough that I thought, okay, I divested of a couple of my businesses and I had extra time. And then I jumped off a cliff and started to become an independent rep for a company, one of the largest ones in the industry, which I'm still affiliated with. But we work in cost segregation and some of these tax services with several companies. It's not just one anymore. I've kind of built a consulting company and an advisory company that we can kind of broker a lot of different things with a lot of different vendors. So that's how I got in the business. It kind of was very much about me and about money I saved personally. And it wasn't any magic thing. It was a real job. It was commission based. And it honestly took me years to really make a decent living doing this job and having this career. I've been doing it for 13 years now. In the last 2 to 2.5 years, I brought a partner on, Lauren Burgess, and she owns a portion of the company. And between the two of us, we kind of built up a portfolio of tax specialty companies. We work with several, and they branch out to about 7 to 8 different tax services. Then we're in the energy marketplace, primarily for very large commercial properties. So small rental houses, I can't really help them out. But if we're talking 30,000, 40,000 square foot facilities and larger, then I have a whole portfolio of energy-based services and some capital expenditure type things, HVAC retrofits, water valve technology, big iron for power usage and being able to streamline voltage into facilities and factories. I do a lot of that kind of stuff. We even do like waste management. It's not sexy, but garbage hauling. I have one client of mine that has 38 multifamily buildings all across the western states. I do cost segregation and tax work for him, but we also have his contract for all his garbage hauling for every one of his locations, probably across like 5 states. And we saved him about 30% on his garbage hauling bill. And then our company takes about 30% of the savings as our fee. And then I make money off of that. So there's a lot of ways we slice it. When I get to the table with an owner of commercial real estate, there's a lot of ways we can help them out. And then a lot of times what happens is they have a portfolio of real estate. We can create deductions, help them out with tax burden. And a lot of times what happens is they don't have enough bandwidth with the amount of deductions we're creating. They're happy that an example would be they owe $2 million in taxes. and I bring them $1.1 million with their portfolio in tax deductions. Thanks, Rob. Did a nice job. Appreciate you. Now I only owe the IRS $900,000, or not, and all of a sudden it's like, that's still a lot of money. So we have another area of our business where we're a partner with a wealth strategy company. So wealth management, wealth strategy. And right now I have a Florida license for health and life. I don't really use it. It just kind of sits there, but we have a separate LLC that just focuses on that portion of our business. And then we've dotted line connect that partner, that client of ours that we saved 1.1 million, and then connect them up to the wealth management company. And they specialize in helping wealthy owners of commercial real estate. And then there are other verticals, kind of is medical professionals like surgeons and doctors too. But what they'll do is, if given enough time, they can potentially make that $900,000 bill. And if that client has a $2 million tax burden every year, which typically happens to wealthy people, they put them on a plan. And it's about building legacy wealth long term with a lot of financial products, insurance products, things like that, but also some cool things. They got one of my clients in the last few months involved. She sold her IT company, and because she was focused in new technology, they found a vehicle within the world of taxation where she became a fractional owner of a data center. And she thought she was retiring, but Rob made her go back to work for 3 hours a week. And she had to be materially participating in the data center activity week in and week out and be able to prove that. She threw several $1 million at this data center investment. She gets a check every month, and then she gets an override once a year for the investment of this. What was cool about that, and then I said, so you cash flowed $9 million. It was 30 years of your life business. You sold your company. How much? And you bought a few rental houses on Pensacola Beach. You came to me. I helped you with a few $100,000 of tax burden, but you had a huge bill with the IRS. How well did you do? She smiled and said, I put $4 million into the data center thing. I didn't pay the IRS, but $97,000. Out of like $9 million. I'm like, oh my God. So she's building a plan with legacy wealth and got that money off the table legally and strategically for long-term wealth.
Yeah, that's incredible. You said she was going to owe $9 million and wound up.
She 30 years of her life her baby was a small IT firm on the Gulf Coast, and she lives in Gulf Breeze. And her and her husband bought 3 short-term rentals on Pensacola Beach. Came to me, I did the tax work for them. I saved them a few $100,000. But with a $9 million cash flow amount, she was probably going to owe more than a third of that to the IRS. Okay. And so she ended up taking a third of that, probably several million, down to less than $100,000.
That's incredible.
Yeah, that's crazy.
Most investors are focused on buying the deals, and they're not focused on tax strategy on the front end of it. Why is that maybe a mistake?
It's not a mistake. I mean, people live and learn, and it's okay. But I will tell you that the people that seriously take proactive time to look at tax benefits, it makes a lot of sense in commercial real estate, even for smaller deals. And a lot of time, what we're starting to do, as an example, to help brokers and investors on the Gulf Coast, not so much in Pensacola, but we're working with 3 different brokerage firms in the Destin and 30A area, where there's very significant large short-term rental properties. Specifically, you guys might know these brokerage firms. One of them is Abbott Martin Group, and the other one is I used
to live across the street from the Martin side of that.
Oh, did you really?
Yeah. They live across from my mom.
I was talking to TJ today.
I know TJ.
He's a good friend of mine. And then also
he's doing a lot.
Watercolor real estate, I think. Watercolor. And that's a big group too. What we've done is we've done this kind of a webinar thing, only it was like a full-on PowerPoint presentation rolling through all aspects, kind of more formalized. Than this is more casual. And then the back end of this thing is we now build when Abbott Martin Group gets on a weekly basis 5 to 10 new listings. And if they're significant and they hit the target audience of short-term rentals, within 2 business days, we're doing proposals for those properties, and no one's even bought those. But we deliver a few pieces of information that come off our proposal, splash them into a one-page document, partnered with a mortgage company. The mortgage company has half the document, and we have half the other side of the one-page document. And it has a bunch of numbers that all focus on mortgage qualifications for that property, and then all the taxation and what the cash flow would be for accelerated depreciation if an investor bought that specific property. So it provides value for the real estate agents that are out there promoting that specific property, and they can have a quick little conversation without knowing a lot about what my business is all about. And they say, hey, by the way, if you were to turn this into a short-term rental, here's some basic numbers about what the cash flow would do and how it can help you with deductions. Are you paying the IRS this year with your W-2 job? Oh, you're going to put this property in service? Oh, did you know about the 100-hour loophole of materially participating to create the real estate professional status, even if you're a lawyer or a doctor? Oh,
we just heard about this on a previous podcast.
Or even a part-time restaurant who's a full-time real estate investor.
That's right. But and what's weird, like with all the things I do, I'm not even a real estate professional. It's crazy. But there's certain qualifications.
Crazy.
I'm in that world. So I train people every day on 100 hours of materially participating towards real estate professional status.
Are you using Reps Tracker? Is that the best? I heard that's the best.
There's actually another piece of software we're evaluating right now. I wouldn't want to say the name of it, but it's a CPA firm out of California, and they created some technology that's pretty cool.
We can talk about it offline, but I'd love to hear about it because
I don't want to give the name out because I don't believe in that till I've really looked at it.
Till you've worked it and used it and things. But so that I was just curious because we just had another really high-level guests like yourself talking in a lot of detail about tax strategies. And honestly, it's been really great having guests like yourself on that are so knowledgeable because that's what we love to give value to the listeners. That's something that I want to know more of, but I'm not a master. You're a master. That's why we love having you on.
The audience that we're that we're talking to right now, are they doing flips? Are they doing long-term, short-term houses?
We have a variety of people on. We've had a lot of multifamily investors on. Actually, the last person who discussed taxes with us was primarily a multifamily investor who also that was one reason I talked to him originally, but he was a tax strategist as his day job as well, so he kind of synced both. But we have
we've also had a couple more recent episodes that are coming out, and they were live on Facebook with people that have $500 million in assets and asset management. So we need to connect you all.
Cool. So we have a large variety.
All right.
But I was actually going to ask you too, if maybe you can give as an example of how tax strategy can directly impact cash flow and long-term wealth, using one of those property examples. You can pick if you want to be multifamily or vacation rental, either one.
All right. So we just finished a property in Boise, Idaho. It's a client of one individual. We all want to be this guy. We all want to be this guy. He's out of Vegas. He builds 1 to 3 multifamily properties every year in the Western states. And they're usually about 180 to 240 units per building. He just finished. He's kind of starting to get into townhouses and higher end townhouses. The last 2 developments. The one I just finished was 80 townhouses in Boise, and he minus the cost of land, he invested $27 million in the construction for 80 properties. Okay, went into service towards the middle of 2025. So this was a 2025 tax implication for him. What we did is we brought 2 specific, very unique products. One of them, and this first one, Well, the second one's cost segregation. I would say most of the people in your audience probably know a little bit about cost segregation,
Right.
accelerated depreciation on commercial real estate, being able to bring anywhere from 10 to 20% of the value of property in a deferred federal tax deduction in the year that you file the cost segregation study. But before, what we did with that $27 million investment, what we did first was what's known as 263A, capital A, not small a, 263A unicap exemption. So what this is, it's a mouthful. I understand that. What it deals with within the code, and it's been in the IRS tax code since Tax Cuts and Jobs Act of 2018. So it's somewhat new, but it's not that new. I have yet to meet us in the last 2 years since we've been supporting and managing projects with this service. I have yet to meet a CPA that knows what it is, that truly goes. That a couple of them went, yeah, I heard a little bit about that. That's about it. They don't really know what it is. So what it does is, if
I'm at the edge of my seat. Tell me.
It's really cool. So here, but there's not a lot of rules around cost segregation. There's rules around unicap. And it deals with soft costs in construction. So there's number one rule, and the overlay is this. It was meant for small taxpayers in the IRS tax code, and this is kind of get a chuckle out of this. You need to be having gross revenues of less than $31 million averaged over 5 years.
Yes.
So if you had a $40 million year, it'd be okay if you had a couple of $28 million years, and it averaged over a 5-year period, 31 million or below. So
wow,
I was so close to not making it.
Dang. So
yeah.
So my clients, most of them they qualify. Okay, so that's the qualifier. Then there's two separate buckets, two ways to utilize this tax service in the code. One, if it's new build construction out of the ground, and you as the owner and investor or small investor community, like a syndicated model, to a small degree. You can't have a massive syndicated model because the ownership can't go beyond a certain percentage. Otherwise, this thing falls apart. You can't use it. So if you had a few people in a syndicated partnership, you'd be okay. And then you're materially participating in the development of new build construction. Okay. So this guy in Vegas, he built it. He hired the contractor. He hired the architect, managed the project. He put it in service, is keeping it long term. Okay. Totally qualifies for the full $27 million. So in the $27 million burn for his construction costs through taking the soft cost application with Unicap, we saved him $6.8 million of that $27 million.
That's
okay. What's cool? What's really badass about this is you may be familiar in cost segregation. It's not that big of a deal, but if you sell your property in a few years, there's some recapture you would have to pay with cost segregation. Sure. And that's part of my world. If you can do a 1031 exchange, you can offset that recapture portion. But it's kind of one of the downside. You got to ask yourself and your clients, hey, you going to hang on to this property for a few years? And it's kind of a checkbox. If they say yes, go ahead with cost seg. Within Unicap for soft costs, what we're doing for those $6.8 million for the client, we wrote all the soft costs off his balance sheet, never coming back. Freaking amazing. Okay?
Just clean slate. And this is
clean slate,
capital A.
$6.8 million runs right off of his balance sheet. Crazy. Wow. So then the next step, once we got those numbers, we had to wait to do the cost seg study because we needed to do the Unicap project first. And then that took the cost basis from 27 million down to 21 million. And then on the 21 million, we did cost segregation on that and saved the client $1.8 million on the 21 million, on the 21 million. Okay. So you add those numbers together, it was like $8.5 million in tax deductions in the first year of operation on a $27 million build. Wow. So about a third of the whole thing.
Because I realized we got a little bit ahead. I do want to real quick for anyone listening who's new, can you break down and a little simply what cost segregation is to a novice?
Sure. What cost segregation is for every, let's make it even small numbers, $100,000. Really, the rubber hits the road around $250,000 to $300,000 in a commercial property. So if you're out there buying single family house and want to hold on to it for a few years, put it in service as a long-term or short-term rental, that would kind of be the low-hanging fruit of cost segregation. Okay?
And just for people listening, when you say commercial property, you mean like, just commercially used to make money. So taking a residential property and then renting it out is the commercial use qualifier.
Yep, totally works. Okay, so what we're doing is you would be assigned, if you kept that property in service, your CPA would assign you a depreciation schedule for that property. If it's short-term rental, it's going to be a 27.5-year depreciation schedule. If it's long-term rental, it's going to be a 39-year depreciation schedule. So in both those instances, what we're doing, what happens with the real estate and being an owner of real estate is a beautiful thing. What you're doing is dividing. If you bought a property for, let's say, $500,000, okay, and you buy and that $500,000 then gets divided by 27 equal slices for a short-term rental, okay, and you get 1/27th of $500,000 every year for 27 years as a deduction sitting on your tax return. Beautiful thing, great thing. But wouldn't you like to have some of that money early? That's what cost segregation is all about. We can go in based on an engineered-based study, analyzing the features of the building with 5-year property, 7-year property, 15-year property, and really defining assets within a building on how they would all attribute to those different life cycles of property. From a can fixture and a lighting fixture. That's an example of a fixture. We're building a whole series of segregated assets in a study that define financially what portion of that $500,000 reflects in different systems and portions of the building. Okay. Yeah. With that said, we're then able to take those numbers and allocate, give or take, between 10 and 20%. And it depends on the quality of the fixtures and how much is there for 5-year, 7-year, and 15-year property. That's why there's a range between 10% and 20%. Okay. Sure. Some vertical properties do better than others, and some don't. If it's a big warehouse with not a lot of moving pieces, it's going to be on the lower end of that 10%, maybe even 8%. Okay. But it could be a huge warehouse that could be worth a lot of money. Anyway, what we're doing is we're taking that 10 to 20%. So if it's $500,000 and we're able to get to 20%, that's $100,000. So what we're doing is it will generate a $100,000 deferred federal tax deduction in the current year you file it. Now, here's the thing where a lot of cost segregation providers like me stop, and I'm going to tell you that's not what you get. Okay, what happens that $100,000 absolutely hits your tax return as a deduction, but realize that amount gets multiplied by the taxpayer's tax rate. So if you're at a 37% tax rate and you make a lot of money, which is like $600,000 or more a year, you're at 37%. You might be at 32, you might be at 28. You might be at 24, whatever that rate is, you would probably be able to go into last year's tax return and go, what rate am I at? Okay, that's what I'm at. So if you're at 37% and I brought you $100,000 in a deduction, that gets multiplied by 0.37. Net, you would get $37,000 on that $500,000 house in a tax deduction that would offset dollar for dollar tax burden in your tax return. So let's just say in that calendar year, you owed $30,000 in taxes, and I brought you $37,000. You would pay the IRS $0 that year. The remaining $7,000 that you didn't use just carries forward to the next calendar year.
And that's perpetuating, right?
Yes. So let's say that next year you did 6 flips and you had tons of deductions, and you had so many deductions you weren't going to pay the IRS anything that second year. And that $7,000 doesn't help you because you already had pent up deductions that wiped out your tax burden. That $7,000 just carries forward to the next year. and the next
And
year after that.
But that's only off a on cost segregation for
Correct.
that property that you're holding, right?
Correct.
I just want to make sure that all the listeners are understanding that. So like utilizing the flip model, and what you're saying now is that that's going to be your active income, flipping
Right.
these houses and things, but you have to utilize that cost segregation on a long-term strategy hold, which is going to allow you to keep that long-term vision in motion. So I just wanted to kind of clarify that.
Yeah, and let me make that clear. I love flippers. I can't help flippers. They're not hanging on to property. Okay.
Right. You need to hang on.
I love flippers because flippers become investors and hold properties later. I usually sit back and wait. It takes about 3 years. And they, I'm flipping properties. I'm making a lot of money. I just did 3. I just did 6. And when they start to get to about 6 to 8 to 10, the capital gains are killing them on every one of these transactions. It's killing them. They make a lot of money. They do great. They make a lot of money. But
and then the other caveat is
they're like, I got 3 flips going. Maybe I'll hold back and hold one and put it in service, and then I'll sell the other 2. And then the next year, maybe I'll hold 2 and sell 1. And they start to build a portfolio over time. I'm working right now with a guy in Birmingham, Alabama. He does between 250 and 300 flips a year. He has three construction crews that are at different sites churning out he basically spends his time doing, he's at the title office doing the transaction work. That's where he spends his days because he's buying so many properties every day. And then that guy, he's got all kinds of short-term rentals all around Birmingham, and he bought on auction a chain of old grocery stores, and he's turning multiple grocery stores into self-storage facilities. And he's doing like 1 a year. He owns them all, and they're all these like concrete buildings that are sitting there, and he owns them now, and he got them dirt cheap. But he only has budget to do like 1 of these self-storage things a year. He's on his 3rd year and he has 3 of them. I think he has like 8 or 9 grocery stores. So they're just sitting vacant, waiting for him to kind of fill out his self-storage business. And then I'm doing the tax work on all these self-storage facilities. And then the flips that he's doing, I can't help him. But on the ones he's holding back for short-term rental, absolutely.
So I was going to say too. Probably the other reason you see it a lot in those years 2 and 3 is I've seen people after a couple of years of them, they look back on those flips from 3 years ago and realize what they'd be worth if they were still holding them, and I realized that they could have got their check over and over again if they would have just kept it and refinanced it. So, but I want to ask also, so how does 100% bonus depreciation come into play when talking cost segregation?
Okay, so now that with the big beautiful bill last summer, 100% bonus depreciation is back in play, and there's no timeline on what's going on, which is kind of unusual and very good for the commercial real estate business. Okay, there's no timelines on this. Can Congress change it? Yeah, they can. But with what's going on with the current White House and how the timeline and trajectory of this is, we're probably good as gold for probably 5 to 7 years. It'll take them 2 years to figure it out. We got a few years left with who's in the White House now. So it's not going to change for a few years if it even changes. So what it means is for improvements on property, and specifically when you acquire property and are going to put it in service, even today, there's a portion of the cost segregation studies that just got supercharged. And what that means is we go in and qualify 5, 7, and 15-year property. And in some cases with some of those sets of data, we're able to extend more than what we were able to do with the 5-year, 7-year, 15-year property and be able to provide 100% bonus depreciation on some of the assets built right into a cost seg study today. So where it's the most powerful, though, is improvements on property. So as an example, okay, if a client had $1 million as a budget, okay, and he's going to go buy, I'll even go with single family home. He buys a $1 million single family home, doesn't need any work. Brings in Rob Schell. We do a cost segregation study. He's going to get that 10 to 20%. If it's $1 million house, it's probably going to be around 20%. Okay. Even with the integrated bonus built into it, bonus depreciation. So he's going to get a $200,000 deferred deduction year one. Beautiful thing. Okay. The other way to utilize that same $1 million in a budget, okay, is he buys a $500,000 house. And then he has a construction project for the other $500,000. And with the $500,000, I'm going to still be providing him about 20%. So I'm bringing him $100,000 in the deduction on typical normal cost segregation. So $200,000 for the $1 million property, $100,000 for the $500,000 property. Now he's doing a construction project, improvements, a $500,000 budget. Puts a swimming pool in the backyard, rips out the kitchen, puts a new roof on, puts an outdoor grilling thing in, puts some brickwork in, and he's got a really, really nice house after he does all this work. Some of the downsides of doing that, some people don't have an appetite for construction. It just is what it is. Other things you've got, it is construction. So you got contractor issues, you got, all kinds of things and nonsense going on with construction. It's kind of a pain. But if you can get past those hurdles and do that improvement project for $500,000, the $500,000, almost all of it, not dollar for dollar. It's not going to be $500,000, but let's say 90%, maybe even 80% conservatively would all qualify for bonus depreciation. So let's just say you got 80% of that $500,000 and you ended up with $400,000 in a deferred deduction. And don't forget, we also got $100,000 for the $500,000.
Now you're saying
$500,000. So it's 400 plus 100. So they got $500,000 of deductions through the cost segregation and bonus depreciation on that project versus the same budget for buying the pristine property without any improvements, $200,000.
So I have a question.
This is $500,000.
I'd like to do this live. And of course, this can be loose. And for all the listeners, this is just an actual project that Sam and I did. And we didn't talk about this before. So if there's something that doesn't work for this example, I just think it would be cool real world and also lining us up to get a study done. So a 5-year, we purchased a property that was completely condemned. We ended up demoing the property and completely building new construction, beautiful new home. And we refinanced it and we're keeping it and holding it long-term, 5 years ideally. Where would this strategy fit into that? And how is that going to help us so that we can get lined up with you and know which direction we're getting before April 15th?
Okay, a couple of things. When you bought the property, were you renting it all after the day you bought it? Like, did you have any in-service for that property? Maybe not in great shape, or was it?
No, it was completely condemned. Okay. The utilities hadn't been hooked up for 10 years. It was
okay. Before I get into the main strategy, let me tell you another secret, another cool thing.
I love it.
If you are buying a property that you're going to be making improvements on, if you can place that property, or let's say you buy a property and it already has a renter in it, and next year you're going to do a construction project on it. Okay, it's in service the day you bought it. And then, you're going to tear it apart. You take your time, hire the architects, hire, design teams, all that fun stuff, and get your budgets all in line. Get your permits ready. Okay. Mm-hmm. What you're able to do, and then the dumpsters show up when you kick the tenant out, and the dumpsters show up and you start ripping. You start taking the whole place apart. All the stuff in the dumpster, we can provide what's known as partial asset disposition, or PAD, PAD for short. Partial asset disposition. We're able, and it's tied into a cost segregation study. If you bought a property, it's in service after you bought a property, and then you do demolition within a 12-month period. Can't do it 3 years later. You got to do it within one tax filing, you have time. And so even if it's like 90 days and there was a tenant in there for 90 days while you own the property, kick the tenant out, and then you did your construction, still qualifies. Okay. And what we're able to do, literally all the cans, the old HVAC system, all the features of counters, cabinets, old stove, old refrigerator, all that stuff, we're able to give you 25 to 30% of original retail value of all that property that you're throwing in the dumpster in a deduction.
Wow.
Okay.
Wow.
And it's tied in with the cost seg study. Is it a huge part of a cost seg study? Nope, it's not. But it's what my partner Lauren and I do is we're all about layers of different services that add right on top of each other, and coaching people that are on this call before they start doing these things so they know, and they bring us in before they buy properties so we can help them with the coaching so they're doing the right things as they go along to optimize the kind of improvements they're putting into property so that more of it falls into 5-year property and it elevates the amount of bonus depreciation you're getting at the end. And then let's say it's a larger project. The other rule set with what I was saying with the soft cost piece, if you're doing, so I didn't even get into that. So let's go back to Unicap for a second. So new build construction qualifies with materially participating. The other area and the other bucket for Unicap is if you're doing construction on established old properties. And if you're doing improvement projects that are in the excess of $350,000 and above, the numbers you can still do Unicap on a smaller amount, but with the fees you pay us and the ROI and the multiplication of all that stuff, the rubber doesn't hit the road till you kind of get to $350,000 in a project. And if you can do that, and let's say you put a $500,000 into a project, not only are you getting cost segregation, if you did it right, you'd have partial asset disposition with pad if you had the tenant in there. And if not, great, then it's not part of it. Then you have cost segregation. It's going to bring you 10 to 20%. Then you have on top of that bonus depreciation for all the improvements on the property, and it's going to add up very fast. And if it's more than 350,000, let's say you did $500,000 of improvements, then that $500,000 in improvements all qualifies as well for Unicap. So we're talking, pad, partial asset disposition, maybe 5 to 7%. Cost segregation, 10 to 20%. Then you've got bonus depreciation. I don't know. It depends how much you're going to do in improvements. And then Unicap will be 10% of the improvements that you're doing, all layered on with different levels of deduction.
So for us, we missed out on the first part, pre-demolition, and we didn't have it in service. Where would that put us for a cost seg on a new build that is worth nearly $400,000?
Okay, so how much did you pay for the property?
We paid $40,000.
Okay, there's not
that
much
was
money
like all in with demolition and all of those things.
Okay, and then you put how much in improvements in cash?
Another $208,000.
Yeah. Well, to be clear, we actually spent 25 on the property, then 15 on demo, and then 200. Yeah, it's about
permitting and all of that to get started.
Yeah, it's about 215 total.
All right, so that specific property is kind of small. It arguably with the 40,000 or 25,000 wouldn't even qualify. Would tell you don't even want to do a cost seg study on it.
Yeah, this was just live, something that we'd worked on.
But with the component of the 200,000 and change for improvements, now you're into bonus depreciation, and you definitely want to flow all that through. Do you really need to do a cost segregation study? Nah, I would talk to your CPA and see if they can just do it for free, and not free, but they can just run the numbers on your costs, and they can wring out, for what I'm doing, they can do 90% of what I'm doing and not charge you the kind of money I'm going to charge you.
Yeah. No. I was just curious because I feel like that's a deal that a lot more people who are listening are going to relate to. Now, we do have super high level listeners that are going to hop in. I was just thinking this is a use case that we've talked about. People kind of followed that. They knew what it was. So
I'd be happy to do a proposal for all those types of properties like that. Happy to run proposals for you. And then once I see the numbers, just like I'm telling you now, it may not be such a great deal, and I'll be the first person to tell you that.
No,
I want long-term clients.
From a strategy,
When you get to the meat of bigger projects, I'll be there with the same kind of sage advice.
now for the strategy point of view, because I like how you just told us up front based on what we paid for land. So what would be the minimum we should pay for land and the minimum we should spend in construction before it makes sense to do the full thing?
Okay, so within cost segregation, it's primarily for the physical structure of a building. Okay, so when we go in and it's a standalone single-family home, we have to do what's known as a land value allocation, and it's fair market value for land with comps in the marketplace, and we have to subtract a reasonable amount. You try to do it as less as possible, but you kind of have to be fair to the IRS and don't play too many games with them. But you need to subtract a portion of your transaction as part of the land value. We can't work with the land value piece. We're only working with the building structure piece. Typically what we see is in suburban markets nationally is 20% land value, maybe 15%. If it's waterfront property like in Destin, we're doing 30 to 35% all day long. If it's out in the rural country, middle of Alabama, and the next town is 15 miles down the road, it could be 5% for land value. Okay, so it really just depends where you are nationally and what the going rate is for land. So we're working primarily with just the physical value. So if you bought a property for $300,000 and it's in a residential neighborhood that is in a suburban area, let's say like Pensacola, it might be in the 15 to 20% range for land. So $300,000, you kind of need to do $50,000 to $60,000 deduction for land value. So it's leaving me with $250,000 for a cost seg study, and then give or take 10 to 15%. I'm going to bring you $25,000 to $50,000 in a deduction on that property. Now remember, that deduction then gets multiplied by your tax rate, so it lowers the amount.
So really, kind of what we pay for the land for what we do as building new construction, what we pay for the land part is not as relevant as what we actually invest into.
Correct. And I can't, if I have people, I'd say once a month, hey, I bought a piece of land. Can you do a cost segregation study? And I'm like, not unless you like turn it into a golf course and move dirt around and build drainage and, put a couple of buildings on it. We can, and I've done golf courses, but it needs to have structure, and I can write off all of those when moving dirt and all the drainage things and all those projects. All the fees for all that can go into a cost segregation study. But the raw land and the value is not part of anything.
Okay, that makes sense. Now, so much information is being covered, and I know we could go a whole lot deeper on that. But I want to, cover a little bit of other stuff. And I know we can't keep you all night. But where do 1031 exchanges fit in today's market? And are those still as powerful tool as they've always been?
Sure, they are, and we do not do 1031 exchanges. I work with several companies, either bankers or attorney law firms that specialize in 1031 exchanges. And there's two benefits that are really a strategy for owners of commercial real estate. Number one, you never touch the money of if you're selling real estate that was in service. And then if you have 3 or 4 properties, little properties, like I'm ready to go to the next step. I want to go and get into that smaller multifamily building. I need to liquidate some of my assets to get into that multifamily building. So I'm going to sell 3 or 4 of my little houses. And instead of touching the money in a 1030, if you touch that money, can't do a 1031. You've got to have an intermediary that captures all the funds in the transactions, a 1031 intermediary, and then they put it in their bank account, and then you have 45 days to be able to define 1, 2, or 3 properties that you're going to potentially bid on and close that would be part of a like-kind transaction of property. And it can be any commercial real estate. Like-kind is very loosey-goosey. As long as it's commercial real estate, you can do it. So you can kind of trade 3 houses for a Dunkin' Donuts. Doesn't matter.
And I was going to ask about that. Was actually just saw. Funny you said the 3 houses for a Dunkin' Donuts. Was actually just saw one of the big real estate moguls I follow on Instagram was just actually he's doing a big post about he's selling all his single family houses, converting everything to commercial, and he was going to 1031 two single family short term rentals into one storage complex. And I was actually glad we had this lined up, because I was going to ask, is that a like kind exchange? You know,
everything is. And here's what 1031 exchanges will do is there's two very big benefits. One, capital gains that would be owed to the IRS on a transaction, and when you close on a property, if you do not do a 1031 exchange, you're going to owe capital gains. So what this does is it defers that capital gains through the exchange to the next property. Secondarily, if you did cost segregation on those three houses, the recapture amount based on the timeline, there's never any penalties with recapture and cost segregation. It's a fair structure of straight line depreciation measured by month and year when you sold the property and how much money was given on a fair market value to you early in the cost segregation study for recapture. And that recapture amount can also flow through the 1031. Okay. So here's a fun story. Got a buddy of mine in Jacksonville, Florida. He owned a self-storage facility for like 20 years. He was cashing out, kind of getting into retirement years, and he sold it for many millions of dollars and was going to do a 1031 exchange. He knew it. He had defined two specific assets in the time, and then you have 180 days after you define in 45 days. Then you have 180 days to close. If it's 181 days, you're SOL. You're out of luck. The whole thing blows up, and you owe the IRS money on capital gains, and the whole thing blows up. So that 180 days is a stressor for investors in real estate. You got to hone in on it. So he knew one of his properties was just starting to come out of the ground and was a Wendy's restaurant, the biggest Wendy's I've ever seen in my life. I'm like, oh my God, it was near Midway Airport in Chicago. And this guy's in Jacksonville, Florida. And then his other property was another self-storage facility. This is a few years ago. At the last minute, he had less than 4 days to close on the 180 days. Someone outbid him and offered them like an enormous amount of money for the exact same property. He didn't have the contract lined up to the point that he was the only person that was going to close on that deal. It was still kind of out there. He lost that, and he was like, oh my God, I got 4 days. What am I going to do? He found a really cool thing with BlackRock REIT, and he got it. He took the remaining money from his self-storage he owned for 20 years, bought the damn Wendy's, got that one going, but the other portion that needed to be fulfilled for the 1031 exchange, he took all that money and pumped it into a BlackRock REIT. Okay, that qualifies for 1031.
That's really interesting, because
and then afterwards, I kind of said, hey, Terry, how did that work out for you? He's like, man, God was looking out for me, because I don't have to manage a self-storage facility, and I get a check every month. and he's like, he said, I don't get, could I have made more money if I had that self-storage facility? Yeah, probably. But I don't have to manage it day to day. And it's a stock portfolio where BlackRock owns 300 multifamily buildings. And I just get my money, and I need to keep it in there for, I think it's 2 or 3 years. There's some rules around it, but he can take the money out. He's got to keep it in there for a few years to qualify for the 1031.
Awesome. I think that's insane. There's a person that purchased one of the local tropical smoothies doing the same thing. So it's funny that you mentioned Wendy's.
Right.
Because they were in a pinch. They did a 1031 into the tropical smoothie, which I didn't think was possible. I was like, I didn't even know it was.
Yeah, we just did it. We were involved. I knew the owner. It's in Pensacola. There's an owner that has some of those like looks like mobile home coffee shops, and there's one in Gulf Breeze and one in Pensacola somewhere. Yeah, scooters. And they did the same thing. They bought those things in a 1031 exchange. It worked out great. And then we did cost seg on the new scooters. And they did. I couldn't believe how well those facilities did.
Oh my gosh, that's crazy.
What are some of the biggest tax mistakes you're seeing real estate investors make today?
Well, I think it runs I think not planning and not understand, not what frustrates me is, as you guys can tell, I'm pretty knowledgeable and I'm caring and I'm nurturing with my clients. I want to help them out. And it frustrates me when I know, especially very large owners of real estate aren't picking up the phone when I call. And I'm like, what are they doing? They're missing
What
out.
are they doing?
You know, why aren't they? Oh, they make so much money that they've got gatekeepers in their office and they're not even taking calls for this kind of a thing or interfacing. And maybe they are, but I'm thinking they're missing out. And I'm telling you, they may be doing cost segregation. Most people are not doing that unicap soft cost nationally. No, not many people have heard about that at all. Okay. And we built a business practice around it.
That unicap one is definitely a more nuanced term, because I've heard about it a little bit, not as much. You definitely helped explain it to me a whole lot more. But like that's not as common of the term as like the bonus depreciation and cost segregation and stuff like that. So no, I think that's really interesting.
And with what we do for larger companies that might be listening in on this call, we have other services where we can go back in time. So think syndicated models of real estate and owners of lots, like maybe even an industrial factory owner, and they have 4 factories. They have tax returns year in and year out. They're closing their books every year. They're closing their books. And there's real estate and depreciation schedules sitting in those books. We can go back in time for as long as they've owned those buildings and go into those depreciation schedules and scrub them from capital expenditures down to and writing off a lot of the features. There's an area within the tax code. It's known as tangible property regulations. It's a very, very sophisticated set of tax code, but it is the law. It is the rule that all owners of commercial real estate must adhere to the tangible property regulations on how they do depreciation on their buildings.
Wow.
Most CPAs, and I'm saying 95% plus, are not doing it correctly. 95%. Do they do an okay job? Yeah, they do. But they're missing pieces of it. And if it's done correctly, what's really cool about it is nickels and dimes are going to fall off the schedules from past years. Those nickels and dimes, depending on how large an investor is or a business is, could be hundreds of thousands, millions, tens of millions of dollars in deductions. Jeez. What we do is we do a consulting project, go back in time, clean up and scrub all the depreciation schedules across multiple years, making them look great in accordance with what the IRS wants to see. And then, so God forbid if there was an audit, they're in great shape. But all the nickels and dimes that fall off we can scrape them, put them into the current year, no amended return. All we need is what's known as a Form 3115, change of accounting practice, one-time event, and then they get all those deductions. We just did a $20 million house in Georgia that we brought. It was about $19 million, and we brought them $1.1 million, almost $1.2 million in a deduction by just cleaning up their depreciation schedules. We still are working this. I just tried to call the guy the last couple of days. Hey, remember we got that cost segregation study coming up this year, because he still can do cost segregation on top. We didn't even get to that. He had a $2 million tax problem last September, a week before tax deadline, which wasn't enough time for us to even do the cost seg studies. We found out that there was some problems in his depreciation schedules. We went in and cleaned them up. This is unusual, but it took our company 48 hours. We sent back in 48 hours, clean depreciation schedules, brought him $1.1 million. He paid us about 7.5% of that 1.1 million as a fee structure. Sure. So it was just money he had said goodbye to a long time ago, closed many years of financial books, and thinking, okay, those are all done. I'm never going to look at those again unless I get audited, and there's no value in them. Oh yeah, there's value in those old tax returns. So our pitch is this: if you have real estate and you've had property for a few years, give us a call and we can look at the last 2 years of depreciation schedules of your filed tax returns, and in a few days be able to tell you, God bless you, your CPA is a rock star. Here's a Superman cape. Or here's your proposal, and we have a range of what we're going to be able to find you, and if you want to do this, we're going to charge you 7.5% of what we find. So it's like free money to them.
Yeah. No, it's a no-brainer. So with that, if someone's listening and wants to start optimizing their tax strategy today, what's the first step?
Give our company a call or find us online. Our company is Innovate Real Estate, and the website is innovaterealestate.net, not .com, .net. So innovaterealestate.net. And there's on the front page, you can click and get a intake form and start to fill out information in about 2 minutes to get a cost segregation study in a couple of days. And then there's contact information on how to get to Lauren and I, and we can start to consult and work with you. And a lot of this stuff on up front, we don't charge for it. So we'll be happy to share and educate and try to become an ally and a resource for you for all things tax related for real estate. And if you have large enough properties, we might be able to help you out with energy solutions and even wealth strategies if you have significant tax deduction needs that go even beyond real estate.
That's awesome. What should people be asking their CPA right now that they probably aren't?
They should, many CPAs, they're all about audit protection and making sure that a client doesn't get audited. So they're very focused on that portion of a tax return, but there's nothing wrong with that. But most CPAs are not focused on strategy and deductions. Sam, I get asked, Lauren and I get asked, I would say 3 to 4 times a week. I don't know about my CPA. Not sure if he's doing a good enough job for me. Do you know anyone that knows stuff about real estate and can help me build a long-term plan? We work with CPAs on a national footprint. Some are great. Some are fantastic. With that said, we have a canned referral CPA list. We send out like 3 to 4 or 5 times a week and say, these ones are good. We've done projects with them. They're responsive. They're professional. A couple of them won't even take you on as a client unless you understand that you must meet with them and pay them quarterly for like 1 to 2 hours every quarter. And you're going to sit down with them and talk business about what's going on in your life, what transactions are happening, what are you looking to do, what happened from the last 90-day meeting, and try to build forward strategy, okay? That is what a really good CPA or enrolled agent EA should do for a client with real estate. And they should know a little bit about some of these tools. Don't diss a CPA if they don't know a lot about what I'm talking about right now and the different types of services. It's an awful lot. Most CPAs engage with a company like ours, and they have a guy that, like me, that works with some of these products and services, and they're bringing them in as part of their team in a back office team, okay? That's what a good CPA will do. If you hear a CPA that's going to do the cost segregation study themselves, oh boy, is that a red flag, okay? It is. Because
you don't want a one-stop shop. You want your CPA.
You ask that CPA, are you doing it? Oh, yeah, I can do it. Oh, man. That's if that CPA ended up in an audit with you as the client in 3 years from now, and the auditor wanted to look at the cost seg studies, I'm sorry, most CPAs don't know what a light fixture costs in the ceiling, and he just did takeoffs and deductions on that light fixture 3 years ago. He's not going to know how to defend it.
Sure.
Right? So our company stands behind all that.
So you need a good CPA and you need a better tax strategist.
What we say is, okay, you have a lawyer, you have a doctor, If you need surgery, do you go to your doctor? No, you go to a specialist. You go to a surgeon. So you need a doctor, you need a surgeon, you need a lawyer, and you need a CPA, and you need, if you own real estate, a tax deduction specialist.
I love it. I love it.
And that's what I do.
Awesome.
So
And
where can the listeners get in touch with you guys? I know you just said your
website. Website's the
direct
easiest way to go, and that's innovaterealestate.net. And that's the best way to go.
Man, well, I just want to give a special shout out to you, Rob. Thanks for being on. This was awesome. I learned a ton. I'm super excited. I'm gonna have to book a call with you. I actually have your website right here. I just connected with you and with Lauren on LinkedIn. I'm super excited. Yep, super excited to get to see more of what you guys are doing. To all the listeners, thanks so much for listening. Clean Eats. If you guys are hungry, if you're a busy professional, I've got my outdoor fridge stocked, my indoor freezer stocked. It's, being a new dad and everything, like being able to pop them in after a long day of work or coming through the house real quick for a quick bite for lunch. I mean, you guys got it. You guys got to get on Sam's meal plan, or just stop by his shop in Pensacola, Mobile, Shalimar, or Tallahassee. I almost said Panama City. And if you guys need any building materials, let me know, specialty or just anything you need. Check out Dufresne Building Materials. And if you need help with your taxes and tax planning and you own commercial real estate, you now know who to connect with. So, Rob, thanks so much.
Thank you, Will. Thank you, Sam, for having me on today.
Yeah, we appreciate you joining us. You definitely, I think, opened our eyes to a lot that's out there. I think we probably are leaving with you answered all of our questions, but I think we're leaving with a bunch more in our head that we're going to be circling back to. You later because
bring me back for another session. Maybe a deep dive in a certain area of the tax code. Happy to do that.
No, I love that.
Yeah, because we definitely want to strategize. One of our goals this year is to get an office, and so that's one of the things we're looking for is we want to make the right move on that to make sure we can do our own cost segregation and make sure it really works for our business. So we'll be for sure give you a call on that. Give us that website one more time for everyone listening.
It's innovaterealestate.net, and I'm Rob Schell.
Awesome. Well, appreciate you coming on again, Rob. We appreciate everyone listening this week, and we can't wait to see you guys again next week on the Elite Real Estate Podcast. Thank you for listening.
Thanks, everybody.
Thank you.
Awesome.